Welcome everybody to another weekly general update for the 17th and 18th of March. And as usual, it's been another pretty eventful week, and we saw some fairly significant moves in overseas markets. The major one to my mind was US government bonds. But just before we start, just a reminder that this is general advice only in these videos. Now, the action for the week: the S&P had a sensational week, gained 34 points, managed to break above the 1400 level, and also stay there, which is really important as well. It's the first time it's been above that level since the GFC in 2008, so quite a significant week. But it does remain overbought, but it has been overbought, for quite some time. But there was a substantial outflow of funds from the managed funds industry in 2011 as people pulled their money out of the stock market and put it into the US dollar and bonds. And that outflow is only just starting to reverse. So in other words, the money's coming back out of those so-called safe haven markets and going back into the stock market. And whilst the S&P has had a terrific run since December, there's still an awful lot of money that's got to come back into the market again. And as it always does, the majority of that money comes in towards the latter half of the run, certainly not in the early part of the run. So I still think there is plenty of scope for more upside in the US market, albeit there'll be some corrections along the way. And on the next slide, we'll just have a look at a few things about the bond market, but that's certainly confirming that outflow of funds from last year is reversing. Now, our market again was pretty disappointing, only up 64 points. On a comparison with the S&P, you would have expected it to be up perhaps double that. But the gains in our market were definitely in the banks. And on the ASX 200, we had a false break of the trend line 2 weeks ago. But to really confirm that we've got a new ball game in the Australian market, it really does need to break and close above 43.50, which is still about another 70 points away. So we need another week like we had last week to confirm that. But overall, our market's still lagging the US market quite dramatically, and that's due to a number of things. It's the high Australian dollar, it's the uncertain political landscape, it's fears over China affecting our major resource stocks, and all those things from an overseas investor's point of view makes investing in Australia that much less attractive. Now let's have a look at bond yields. They spiked for the first time since October last year, so that's significant. It's nearly 6 months since we've seen a spike as we did in the last couple of days. And that typically means when bond yields start going up and bond prices start going down, it typically means that inflation is now expected. The world has been factoring in deflation now for quite a few years since the GFC, but we're now seeing some inflation expectations raising their head, as indeed they should, given the amount of money printing that's going on. So because people now are less fearful about what's happening in Europe, they're less fearful about a systemic collapse, then money's coming out of the so-called safe havens and going back into risk assets being stocks, commodities, etc. Now this could cause, with the bond yields spiking, which means that long-term mortgage rates are going to go up in the States, which is obviously not what the Fed and the US government wants. It could cause the Fed to print more money to offset the impact of those rising long-term rates. So that's a possibility, and that will be, in the short to medium run, that'll be positive for markets. However, in the long run, it's very bad, but that may take 2, 3, 4, 5 years to actually play out. Now looking at the US dollar, we had a period there where the US dollar was going up and commodities were going up, and stocks were going up, and that's incredibly unusual. You'd normally expect the US dollar to be going in the opposite direction to stocks and commodities. For a short period that wasn't the case, but now it's starting to behave normally again, and the US dollar went down on Friday night. And we'll have a look at that chart in a minute. Now gold lost $50 on the week, so gold still under pressure. Excuse me. However, this correction that we're getting is just taking a little bit longer to play out. It's a bit more complex than you would normally expect, but it's still, to me, part of the normal corrective pattern. So for me, 1626 is now the potential support line. The price of gold has been down pretty close to that, got to within $6 or $8 of that last week. And so it's possible we may have seen the bottom, or we might have just a little bit more down still. So we had a strong wave 1 up. This is still in the wave 2 correction, and eventually we'll get into wave 3 to the upside, which is the most powerful wave typically of any advance. So I'm still expecting a higher move from here towards 1900 and beyond, and that I think is how it will play out for the rest of the year. We'll also take a quick look at the US gold mining indices, the GDX for the major miners and the GDXJ, which is the juniors. And there's really no question that inflation is now back on the agenda with bond yields spiking. So we are going to see a response from gold at some point. Now silver similarly down by $1.50 on the week, and the same comments as for gold apply. Oil consolidated some recent gains, but still looking very strong. And surprisingly, with oil at this level, you would expect people to start be getting concerned about global growth, but at this stage, no one's talking about that, and certainly markets aren't reacting in any kind of negative way to the high oil price. Copper reasonably steady on the week and still fairly close to $4 a pound, which is still a very buoyant position for most copper producers. The ones in Australia somewhere typically between $1 and $1.50 a pound. So with the price of copper at $4, it's a very, very profitable period at the moment. And we'll have a look at Caterpillar as well, which I use as a bit of a bellwether for the health of the global resource industry, and it's still looking pretty strong. So I'll just touch briefly on strategy before we move over to the charts. The S&P 500, I believe it'll head towards 1440, but it would be incredibly unusual for it to go straight there without some kind of correction, maybe 30 or 40 points like we saw a week or so ago. So I think you can expect some volatility. That means you just need to exercise the normal care and prudence. Don't go jumping over prices thinking that there's only one way up, because there won't be. There'll be some pullbacks. With respect to overall exposure, obviously the amount of cash that you keep up your sleeve is very dependent on your own trading style and tolerance to risk. But my recommendation would be to keep some cash up your sleeve, if for no other reason that there will be, over the next few weeks, there'll be some great bargains when we do get the inevitable pullbacks. Now, with respect to the entry technique, and this is unchanged from last week, really we're looking to gain as much advantage as we can, and using principles of reversion to the mean to limit our risk. Exit techniques, I'd be taking partial profits pretty regularly, and exit fully on confirmed reversals. So I think the key is here, when the market's been going this hard for so long, is to continually turn your money over and make sure that you lock in some of those profits. So let's have a look now at the actual charts, and this is the chart of the 30-year US Treasury bond. So this is the bond that really sets mortgage interest rates. And if we pan back, you can see it's been certainly been in a decline for some period of time. Interest rates got down to levels very similar to where we were at the end of 2008. And as you can see, we've just had a bounce. We had a bounce back here in October, and now we're just starting to bounce again. And you can see there's been a bit of a drift upwards in the last 4 to 6 weeks. So I think that's a pretty significant sign. Now there's been a few false starts before, and this could well be another false start, and it just settles back down again. But I just have a feeling that this time we might see a more sustained rise in interest rates, and that's certainly going to put pressure on the Fed and the government, and I think pressure perhaps on the Fed to print some more money. So in the short term, all reasonably positive for stocks and commodities. Now let's have a look at the US market, and this is the S&P 500, and we've broken above 1400 for the first time since 2008, and you can see that we've had a really impressive run since the 20th of December. Now that was when the ECB basically made available $500 billion. They didn't call it money printing, but that's in effect what they did. And since that time, the only correction of any real significance at all was really one day, which was the 6th of March, where the S&P fell about 25 points on that one day, and then the market immediately turned around and just went straight back up again. So this has been enormously strong, and other than that very, very brief period of 1 to 2 days, the S&P has been overbought since about the middle of January. So just because it is overbought at the moment does not mean that it can't keep advancing. So we need to participate because this is a great opportunity, and I think 2012 is set up as a generally pretty positive year. But just recognise it is stretched, and a 20, 30, 40 point pullback in the S&P can basically happen at any time. So that's the key thing to remember. Now let's have a look at the US dollar index. So we did have a period there last week where the US dollar index was rising as stocks were rising, but now things have come back to normality. US dollar index is on a bit of an uptrend, and this is really largely because the euro was in a downtrend really, and so it's really a bit hard to say exactly where the trend is on the US dollar at the moment. It could well now be in a sideways pattern, so we really need a bit more information. And I think with things improving in Europe, I wouldn't be surprised to see the euro start to gain strength, and the US dollar perhaps start to head back down towards the mid to low 70 areas, which means by correlation we're going to see the Australian dollar head back towards 110. Now let's have a look at gold. And first of all, gold on a weekly chart. So you can see here we've had one leg up. So after the, I'll just put some trend lines here. So we had this massive bull run that really finished around about August last year. So we ran from here to here. So we had a one leg down. So we get a typical ABC correction to the downside. So that completed the correction then into the end of December. So that corrected this whole run that started really back here, probably October of 08. So we've had a big run up from October of 08. We've then had an ABC correction to the downside, which is perfectly normal, what you'd expect. We've come down to the bottom of the Bollinger Band, so we're down at a statistical extreme to the downside, and now we're starting the new advance in the next leg of the big picture bull market. So far what we've had is we've had one leg up, and we're now still in this, so we're now getting one leg up. This is the second leg down, which again is normal. And then I would have thought very, very soon we're going to be into the third and strongest leg, and that could well take us up above the 1900 level. In fact, I expect that it probably will. So that's where we are with gold. And whilst when you're looking at it day by day, it seems a bit frustrating, and it seems as though the correction will never finish. When you look at it on a weekly basis, it's not really that big a deal, to be honest. And what I'm starting to hear and see now, and getting questions from many people, is that people are now starting to really question whether gold is ever going to go up again. You know, is the 11-year bull market in gold finished? And that's the sort of thing that I want to hear, because the bottom will be in or close when people start giving up on gold. You know you're very close to the bottom when that happens, and that's what I'm reading, and that's what I'm hearing in questions at the moment. So I'm still very, very positive on gold. Look at silver. This is on a daily basis, and it's really doing the same thing. We've had, as you can see here, an A, B, C pattern to the downside, and it's still really just playing out at the moment. It's a little bit more complex. I'm really looking for perhaps $30.50, although there is a level here at 31.80, which has basically been hit so far. So silver will just follow along with gold. Let's have a look at the Gold Miners Index, and this really is a very sad story. And the Australian gold miners, fortunately, have done far, far better than the gold stocks overseas. So that's one area where our market is outperforming. So this is the GDX, the Gold Miners ETF. It covers 16 of the world's largest gold miners. And you can see it was a pretty bad week last week, and there's almost a bit of a slight downtrend in place, which really is quite amazing. So gold miners, they didn't participate in the upside, and yet they're experiencing some of the downside when gold corrects. So it really is quite a sad situation, and it's really quite illogical, and it will reverse itself. Now this is the GDXJ, which is the index covering the junior gold miners in the States, and again, not a particularly flash week, but I really do expect that this will turn around, and often gold miners will play major catch-up towards the latter part of the overall market in gold. Now the other one I wanted to have a look at was Caterpillar, which is really a good indicator of what's going on globally in the health of the resource industry. Caterpillar's had a fabulous run, as you can see, which started in 2009, down around $24. It ran up to 115. We then got an A, B, C pattern to the downside to correct that major run, so that's all fine. And we've now had a run up, formed a double top, pulled back very slightly, and now quite possibly getting ready to advance again and break to a new high. So certainly Caterpillar is telling us very, very clearly that at a fundamental level, the world's resource industry is actually in pretty good shape. Now, the world's biggest company, Apple, always worthwhile keeping a bit of a tab on them. It looked like we had a reversal back here a couple of weeks ago, but that really didn't come to anything much, and it's just turned around and gone straight back up again, and actually traded over $600 a share on last week. So Apple just ridiculously overbought, but really showing no signs of that momentum waning. Let's have a look at our market. First of all, the ASX 200, and you can see, if you recall what the trajectory of the S&P looked like, it was very, very healthy. This is pretty pathetic. You can see we've got a wedge pattern that had formed up here over the last few months. We broke down from that wedge pattern just over a week ago, quite sharply in fact, but as it's turned out, that's been a false break, and we're heading back up again. But to really demonstrate that that we're going to perhaps go into a bit of a trending market here in Australia, we really need to close above this 43.50 area, and then I think we could perhaps have a run towards the 4600 mark. So that would be the one to look for. And finally, just checking the Small Ordinaries Index in Australia. This is the XSO. You can see it's definitely outperforming the main index. It has been rising quite nicely since December, whereas the main index has really just gone sideways. So the activity level really is in the small caps. That's where the money is to be made, but you just need to be prudent, careful and disciplined in the way that you operate. But I think we're still in a very, very good period in the market. So that's it for this week. Talk to you next weekend. Cheers.
If you want to trade and invest with us with a big edge on the market, go to our website, specialistshareeducation.com.au. You can access our free video series on creating trading cash flow and smart investing. Plus, you may also register for our weekly Ask the Expert webinar.